Hey everyone, welcome to my new video. Today we're gonna be talking about one of the most important companies in tech world, Google. Now check this out. Based on the PE ratio here, Google is actually the cheapest stock among the legendary Magnificent Seven. As you can see, sounds surprising, right? Take a look at this chart. Google's trailing 12-month PE ratio is sitting at around 18. That's not only below its historical average, but also way lower than the rest of Magnificent Seven. And just for comparison, Meta is the next cheapest one with the PE ratio of 24. And then there is a huge jump, Apple with a PE ratio of 32 roughly, okay? So what's going on here? Why is Google trading at such low valuation compared to the others? Let's find it out. Alright, let's start by zooming out and looking at the big picture. Google's revenue growth. And to be honest, this chart looks amazing. As you can see, Google has been consistently growing at double-digit rates year after year. And what is more surprising, as you can see from the chart, in 2023, revenue grew by about 11% year over year. That's outstanding. But what is more better, in the last 12 months, growth actually picked up, jumping to almost 14%. So not only is Google still growing fast, but the growth is also accelerating. That's rare for a company this size and maturity. I mean, think about it. Double-digit growth with a PE ratio under 20? That's not something you see every day, right? What's really going on here? Let's dig deeper. Okay, so lately there's been concerns about the future of Google search. So to get a better understanding of what's really going on here, let's break down Google's revenue into smaller pieces using data from Qualtrim.com. And as you can see from this chart, this company is actually well diversified, okay, with multiple revenue streams. Let's take a closer look at where the money is coming from. Alright, let's start with the big one, Google Search. And as you can see from this chart, search alone makes up roughly half of all Google's revenue. So that's a massive chunk, and we can filter it. Okay, yeah, now we can see only Google Search. Right, that's better. But there is the thing. This is exactly the part that's under question right now. Many investors are getting nervous. And why? Why are they getting nervous? That's because there are growing concerns that Google might start to lose its dominance in search. We've got a wave of new AI tools coming in, for example, ChatGPT, Llama, Gemini, Grok, and list keeps going. And to be honest, I found myself using ChatGPT more and more every single month. So yeah, we have to be aware of this threat of these large language models. And of course, Google isn't just standing still. That's true that they've launched their own AI model called Gemini, and if search ever slips, they could still benefit from that, I think. Because here's the catch, right? If they lose their grip on search, they might not hold the same monopoly-like position they've had for years. So the big question is, do you think Google can rebuild a similar level of dominance in this new AI era like it did with search? Because right now, ChatGPT has the first mover advantage, and the competition is just heating up, right? But there is something very interesting. If we go back to this chart, it looks like nothing's wrong at all, right? There is some nice upward trend. In fact, Google search revenues grew by 13.5% in 2024, so that's even faster than the year before. Still double-digit growth in a space that's supposedly under pressure? That's pretty outstanding, I would say. Okay, so next up we have YouTube ads. Let's talk about it for a while and just look at this chart. It shows a clear upward trend and again, very impressive numbers. But here's the thing, YouTube's ad revenue is still about 5 times smaller than Google search, and that might sound small in comparison, but let's take a step back and think about this. What other video platform even comes close? We have Netflix, okay, that's understandable, maybe Amazon Prime, but honestly I think YouTube is in a league of its own. And get this, Netflix's management believes they could reach a 1 trillion valuation in just 5 years. If that actually happens, that what would YouTube be worth? I mean, think about it. What if YouTube alone is worth $1 trillion 5 years from now? And then you've still got Google Cloud, subscriptions, Waymo, and all the rest. So I found also in their latest quarterly report that YouTube Shorts engagement is up 20% year over year. So that's a nice development. And monetization, especially in the US, is getting stronger. I truly believe YouTube will become a much bigger piece of the revenue pie in the future. Okay, now let's move to Google network revenue, and this includes advertisements shown on third-party websites and apps, and it's not a huge piece of Google's total revenue. And as you can see, there's been a slight downward recently, right? But honestly, what do I think about it? It's not a big deal, I would say. That small dip is being offset by strong growth in other areas like search, YouTube, cloud, so there is nothing to worry about here. Alright, next up let's talk about subscriptions, and this includes things like YouTube Premium, Google One, and subscription from StorePlay. And the growth here is smooth and steady, so we're seeing a double-digit growth. It might not be the biggest revenue stream yet, but it's consistent and clearly gaining momentum, so definitely a solid area to watch going forward. Okay, and now let's talk about Google Cloud. And this segment has been growing like crazy, as you can see. It's up 30% year over year. So, and here's the big news. It's finally turning a solid profit. I can show you this chart with cloud operating margins. And as you can see from this chart, their margins have improved significantly. So what's driving this surge? You have to take into account massive demand for AI tools, big name partnerships like with KPMG, and Google is investing billions into building out new data centers. So yeah, that's really nice to see. So Google Cloud, is no longer just playing catch up with AWS and Azure, but it's starting to look like a real cloud powerhouse. Okay, let's go back to the revenues, and finally let's talk about the last piece of the puzzle, other bets. So this includes projects like Waymo, Google's self-driving car company, and guess what? Waymo is currently the only fully operational robotaxi network in the world. Now this part of Google's business is still very small, as you can see in terms of revenue, but the potential here is huge. Think about it. They start small, perfect the tech, and scale over time. We saw the same thing happen with Google Cloud, and now it's becoming a major profit engine. And Waymo is already making big moves. Okay, let's pull up this chart, and as you can see, they have over 250,000 paid passenger trips per week. That's substantial, and that's a 5x increase year over year. And over the last 2 years, they've scaled 20x. That's exponential growth, so there is a big potential here. And plus, they've just partnered with Uber which means that in certain cities, Uber users can now be matched with a Waymo autonomous vehicle when choosing right options, and it's definitely something to keep an eye on. Alright, now that we've covered the revenues, let's dive a bit deeper into the financials and starting with margins. So take a look at this chart, and Google's gross margins have been consistently around 60%, as you can see, and they've stayed remarkably stable over time. And it's not just gross margins, okay? I can pull up operating margins or profit margins, and just look how steady and strong they've been. This kind of consistency shows one thing very clearly, and that is Google runs a highly profitable and resilient business, which I love to see. Another chart I'd like to show you is this chart with the share count. And as you can see from this chart, Google has been consistently buying back its own shares, which means the total number of shares has been going down over the years, which is very important because as a shareholder, it means I'm not being diluted. It's very important. Fewer shares in circulation equals more value per share for the rest of us. So that's always a good sign to see. Now let's combine that with the earnings per share chart here. And when you put together a shrinking share count and strong net income growth, what do you get? It's simple. Almost 40% earnings per share growth year over year. And that's seriously impressive, especially for a company this big and this major. So it's very impressive to see. Next up, I wanted to show you the free cash flow chart, but honestly, it's not that useful right now because most of the Magnificent Seven have been heavily investing into capital expenditure. Okay, we are talking about things like AI infrastructure, data centers, and cloud expansion. So naturally, as you can see here, free cash flow takes a short-term hit, and that's totally expected. In this environment, earnings per share is actually a much more reliable metric, I would say, and as we saw earlier, it's looked very strong. Okay, and now let's talk about return on invested capital. And over the past 4 years, as you can see, Google has managed to keep this metric right around 30%. And that is outstanding. It's a clear sign of just how efficient and effective this business really is when it comes to using its capital. So from an investor perspective, I really like to see that. Okay, and the last thing I want to highlight is Google financial health. Just look at this chart. They have significantly more cash on hand than total debt. In fact, they could pay off all their debt tomorrow if they wanted to. So, Google is in excellent financial shape. Okay, so far I've looked at the financial statements, key ratios, and even what the management has been saying in earnings calls. And honestly, there is nothing to worry about. Everything looks very positive overall. But actually, there is one thing I'd like to discuss with you before we jump into valuation, and that's the ongoing lawsuit against Google. To make it short, basically, the US government believes Google is just too powerful, especially when it comes to advertising and search, online advertising and so on. And the Department of Justice is pushing hard for Google to sell off Chrome, saying that it plays a central role in maintaining their search monopoly. And keep in mind that this lawsuit could take years to resolve. But it's definitely a huge risk. And why? Because Chrome isn't just a browser, it's the gateway to Google's entire ecosystem. Okay, bookmarks, logins, apps, analytics, ad tracking, and even AI integration. This is very important because everything is tied together, and losing that integration would seriously weaken Google's moat. And that's something investors need to keep an eye on. All right, let's move on to the valuation. And the big question is Google a good buy right now or not? Well, to do a quick sanity check, I compared Google's P ratio to the S&P 500's forward P ratio, and here is what I found. The S&P 500 is currently trading at 28 forward P ratio, okay? While Google, as we saw earlier, is sitting at about 18, right? So there's 10 difference. So that's a huge gap. And now remember, our goal as investors is to outperform the market, right? And there are two ways Google could help us do that. So the first case is Google outgrows the S&P 500 in terms of earnings. And if it stays at a PE of 18, that alone would be the market. Or Google grows at the same pace as the S&P 500, but its P multiple rises back in line with the index. So again, that would also be the market and lead to outperformance. But here is the best case scenario, and it's not impossible, I think. It's real. And if Google grows faster and investors get more bullish, pushing the stock back toward the S&P 500's valuation multiple, then we are looking at a substantial outperformance. So in my view, there is a huge potential here for Google to beat the index, so both on growth and valuation. So it seems very interesting to me. Okay, now let's run a quick DCF valuation on qualtrim.com based on a simple 5-year EPS projection. And here are the assumptions I'm using. So, and just a reminder, I'm being very conservative here, especially considering the risks with Google search. So first I'm going with a 16% EPS growth rate over the next 5 years. And that's well below Google's historical average. The 5-year average was about 29, I think, yes, and the 10-year average is around 24. So I am being very conservative. So 16, it's nothing. And so again, this 16 is playing it safe. For the P ratio, I'm assuming it stays at around 18, which, as we've discussed, is way below its historical average. So even with these cautious assumptions, as you can see, we are still looking at an estimated return of around 15% from today's price. So that's a pretty strong outcome, especially considering we've used such conservative numbers. You know, so if you are looking for long-term value with a margin of safety, Google might just be it. So a big question, what am I doing right now? Well, even considering the risks, actually the uncertainty around Google search and the ongoing lawsuit could potentially separate Google Chrome from the rest of the company. I still believe the risk to reward ratio is positive. In my opinion, the positives outweigh the risks. We are talking about strong financials, stable high margins, massive potential from Google Cloud, YouTube, Waymo and other segments, plus multiple diversified revenue streams. And let's not forget, Google is everywhere. Their products are used by billions of people every single day. Even if search gets disrupted, it's hard to imagine a world where Google search revenue drops to zero. They'll adapt, they'll innovate, they'll always do. So all things considered, I think Google remains a very solid long-term investment. So actually at this price, I'm adding more shares into my portfolio, but always do your own research and make sure it fits your investment strategy. So that was my take on Google. If you found this video helpful, please make sure to hit the like button, subscribe, and thanks so much for watching, and I'll see you in the next one. Bye.